Hey guys, welcome to this video. Will Sebastian here again. In this one we're going to cover indicators and the correct way to use them, because there's a real sort of ideology out there about, the way to use them, and it's quite incorrect and it causes people to lose a lot of money. So let's talk about the right way today. So let's get the word up on the board here. Let's get the word indicators nice and clear. Okay. So there you can see across the top of the board the word indicator. So what are indicators? Well, most people generally know this if they're involved in trading, but indicators are there just to give an indication to the trader of more or less the way the price is at the moment in terms of what's previously gone on. So all indicators do is take previous price data and then make an average of it. They all do the same thing really, and then they print a line or they print some point of reference to allow the trader to keep intact. Okay, so let's just, for example, draw out something like this, a make-do chart. Normally we'll look at charts in terms of candles, but the idea of this video is much easier to understand if you just look at it like this. So you might have had a particular asset, okay, that does something like this. Okay, we all know it doesn't matter what it is, right? You've obviously got your peaks and your troughs, as the price goes on over time. So let's say this is just 1 month. Let's say perhaps this is a month with 30 days in it. So let's say November or something. You can see that this, all the data in here, so this would be candles, but we're doing it as a line. All of that between the first day and the 30th day is price data. So where the price was bought, where it was sold, where it was bought, where it was sold. Now, if you applied something that we commonly use, like a moving average, it would look something like this. Okay, so I've got another pen in my pocket because normally they're different colours. So it might look something like this. Okay, so there's your moving average of whatever it may be. Roughly, it would be something like that. And you might apply another moving average to it, okay? And that could be in blue, so it might be something like this. And it'd be slightly higher up, okay? And it might cross over at some point, right? And that's the way your moving averages would go. So when they're drawn on the chart, there's two ways you can actually use them to validate the price, okay? Now, the easiest way to do that is really by looking how far the price is off the moving average at any time. But what lots of traders actually do in their trading, which causes them to get it wrong, is they do something that I call a sort of magic line sort of theory, if you like. So they say, okay, well, I can see the price has crossed over with the moving averages there, for example, so I'm going to sell this, okay? And obviously what happens is the price then comes up to here, right? So they might say, okay, well, I want to short this, and then the price comes up further. So what they've done is they've just taken a simple rule that they've made up. When the price hits it, I'm going to sell. Now, obviously that doesn't work, because otherwise everyone else would be doing that. They'd be doing that all the time. So what you really need to do instead is just look at how far the price is away from the moving averages, for example, or how far the price is away from your indicators. So if you added another moving average and it was like this, and it was a bit more extreme, you might be able to say, well, I can see with this far off this moving average, okay, at that point, and then again here, and therefore I know what is a high and a low price. This becomes a high price because we're further away from the moving averages. Obviously it's on a minute scale and I'm doing it quickly on a whiteboard, but really what you need to understand is we're not looking for indicators to get hit. Whether it's a Fibonacci or a moving average, it doesn't matter if they get hit and then price comes away. That's not what we're looking for. We're using them as almost weather gauges, okay? So what the temperature's like. If the price is far away from a moving average, we know the price is high, okay? If your stochastic oscillator or your relative strength index is really high up top, we know that the price is likely already moved high again. We're not looking for any lines to be hit and a magic reversal to happen. We're looking to gauge the value of the market at all times. Is the price high, and is that there for a short, or is it low, and is it better for a long? Okay, so you can really tell how that goes, guys, and it's simple. You're just using the moving averages or any different indicator to judge how far price is at any time from reality.